Hey everybody, it's Jeff Kikel here once again with another episode of our Retire Free series here on the Exit Rich Retire Free channel. Today I want to talk to you a little bit about a pretty much unknown topic that most people just aren't even aware that exists. So we're going to talk about net unrealized appreciation. So if you've got company stock sitting in your old or in your 401k and it's grown a lot over the years, there's a tax rule most people have never heard of that can save you serious chunks of money. Now, as I've said, it's called net unrealized appreciation, or we will call it NUA. Now, it's not for everyone. The rules are extremely strict, but when it fits, the savings can be big. So let me walk you through it. Here's the idea in plain English. Say your company put shares into your years ago. They matched or you were able to buy it inside of your 401k, however it got there. And let's assume that those were $10 a share. Now say today they're worth 100. Now that $90 of growth is your net unrealized appreciation. Normally, everything that comes out of a 401k gets taxed as ordinary income, which for a high earner is the most expensive tax there is. NUA lets you pay ordinary income tax only on the original $10 cost basis. And the big growth number gets taxed later at a lower long-term capital gains rate instead. So let's put a real number on it. Imagine company stock with a $50,000 cost basis that's now worth over $500,000. That's $450,000 of appreciation. Roll it into an IRA like most folks do, and every dollar you put out later is ordinary income, up to 37% on the top tax brackets. Now, if you use NUA instead, you pay ordinary tax on just the $50,000 basis, while that $450,000 gets taxed at capital gains rates, which top out at 20% and can be 15 or even 0 for gains at lower brackets. That spread is the whole reason that this strategy exists. Now, the IRS is very strict here, so pay attention to three things. First, you need a triggering event. Either you leave the company, you turn 59 and a half, and this is only if the plan lets you do insert what's called an in-service withdrawal, or you become disabled, or you pass away. Second, you have to take a lump sum distribution, meaning the whole plan empties out within 1 calendar year down to 0. And third, the company stock has to move as actual shares in kind into a taxable brokerage account, not sold inside the plan. And here's the one thing that hurts most people. If you roll your 401k into an IRA first, then you think about NUA later, or you've heard about this, your opportunity is gone permanently. This has to happen at the distribution point, not after. So when does this make sense? When do you do it? NUA works best when your cost basis is low compared to the current value because you're paying that ordinary income tax up front. If the basis is high, that bill can sting. And if most of your net worth is already riding on your employer's stock, sometimes diversifying is the smarter move, even if it costs you a little tax. And this is a run the numbers decision. You only get one shot at it. So if you're about 10 years from retirement and sitting on a big pile of company stock, this is exactly the kind of thing worth modeling before you make a move. This is what we do at Freedom Day Wealth, as well as my tax practice, Profit Pilot Tax and Financial Services. We'll be glad to help you out. Of course, these are for education and investment. Stop. I'm Jeff Kikel with Exit Rich, Retire Free. This is for education, not investment advice. So talk with a qualified professional about your own situation before you act. And if we can help you, you know where to reach us. Thanks and have a great day.